Well, thank you everyone for joining us again for another episode of In Good Company. Today we have the pleasure of Graham and Ashley from Gen H, and we're going to dive into how specialist lending like Gen H is really revolutionising the lending space, and it's really reshaping home ownership, whether that's through different partnerships, product innovation, and a lot of broker-led ecosystems. So thank you very much both for having us on the show today. It would be great to kind of start off with an introduction to yourselves, tell us about what your roles are at Gen H, and perhaps even how you kind of found yourselves in Gen H.
Do you go first?
Yeah, sure. So I joined Gen H almost exactly 5 years ago. I was after Ashley, I was about employee number 20. Originally, I was an investment banker for a long time. Left that world for many reasons, mostly because I wanted to do something that had a bit more value. I joined to sort of start building the partnerships to bring the funding we needed to lend. Fast forward today, and I'm CEO after the founder left the business about a year ago.
And I'm Ashley. I'm Chief Operating Officer. I joined nearly 6 years ago. I started working in big banks, and then and I was in the product team as well, and it was just really challenging to get anything actually delivered. So I really wanted to go somewhere small that was much more fast-paced and was much newer and just could get things done much quicker. And I stumbled upon Gen H, and it was a time when they didn't have a license. They were still trying to apply for it, and they were like, we've got this big problem, and we're going to try and be a new lender, and we're going to try and help people get into homes. And I was like, that is a problem that I have. I wasn't a homeowner when I joined, and it was just a really big new challenge. Nothing had been built. We wanted to build everything from scratch. I was like, what a fun place to try and be a PM if I'm going to go to any sort of startup. So that's why I joined Gen H.
It's a very cool way to start, and very interesting ways to kind of enter Gen H, and from investment banking to something slightly smaller. But it's fun that we get to trade office seats today for a bit of a Hollywood-esque podcast, or I wish it was Hollywood, but not quite.
Closest I've ever been.
Yeah, exactly. Well, it's not raining, as we said, so it could be worse. But yeah, very interesting. And we all know that, that the property ladder and home ownership at this time is kind of in dire situation. You've got really terrible affordability struggles and deposit hurdles for the everyday person who just wants to buy a home. And I wanted to kind of turn to you, Graham, and pull you in naturally and ask you about, was this Gen H's mission, and what is it, if not that, to try and get people onto the ladder, and how you're trying to achieve that?
That's exactly it. I mean, you've hit the nail on the head. Home ownership is a struggle for more and more people. I think everyone at Gen H believes that it's a social good for people to own their own homes. I mean, there are definitely situations where it's not right for people, but I think for most people, having certainty of where you live, the cliched roof over your head, but also certainty as you work, you get older, you own your home, you've got a lot more security, and you're starting to build wealth in a way that you don't when you rent. And there's lots of challenges. There's sort of the usual talk, we're not building enough homes. I don't think any of us feel equipped to go out there and start laying bricks. So we take the next best thing, follow the money. And how do you make it so that you can responsibly lend money to people who want to be in a home that are otherwise shut out? And that's, that was the genesis of the business. What can we do to get more people responsibly into home ownership, and what are the levers that we've got? Without going down a rabbit warren, there's lots of big lenders out there doing lots of good things. If you are, in a secure job and you're a PAYE earner, and you want to borrow at 90, even 95 LTV, typically as easy as a couple, then there are good solutions out there already. We're not trying to usurp Barclays or Nationwide or HSBC. That are their systems perfect? No. Could they be better? Yes, I'm sure, but they work really well for most people. I mean, I have a big lender mortgage. I believe Ashley does too, right? They work for a lot of people, but the number of the people they work for is shrinking, and that is people who may be affordability constrained but actually can afford a mortgage. What can we do to help that? What about people who have multiple income sources? They are less well served by the big banks. People who are recently self-employed, work for micro SMEs, run a micro SME, are contracting, are on zero hours contracts. These are, a minority of the working population, but a large and growing one, and those are the people we're trying to help.
And you touched there on kind of the concept of security and being able to own a home in a responsible way. Where do you see that kind of, what was once a niche segment of the mortgage market being so-called specialist lending, where do you see that evolving? Do you see that growth happening already?
Yeah, I mean, I think it's going to grow. It's be interesting to see what Ashley says too, but I see it growing in two different ways. So one, there is a growing number of people who need that sort of support, right? The big lenders are really good at doing things quickly if you fit their mold, you fit their pattern, and that will continue. But there are more and more people who don't fit that mold, that don't fit that pattern, and so there is a growing need for specialist type expertise. So I think there is a natural growth in specialist lending just because A, that population is getting bigger, and B, I don't think the big lenders are going to come into that space anytime soon. I might be wrong, and they might do some things around the edges, but I think in terms of the people with really complex income, I think that will remain a specialist lending product for the foreseeable future. And then I think there is also increased creativity and what can we do to lend responsibly. So for us, that's today we are an incredibly prime lender. We have close to zero arrears and are got several hundred million, well over $1 billion lent out there. We have no arrears. We're doing things incredibly responsibly, probably too conservatively. So we are thinking about how do we bring people who've got blips in their credit file and give them access to our products. We're, geographical expansion. So we've always wanted to lend in Scotland. We launched that a couple of weeks ago, thinking about what we can do with product and product iteration and increase the field of people that we allow to access to our products, and we see others trying to do the same.
Yeah, and even by adding on other people onto the mortgage as well for additional support, in theory, if an owner lost their job or something, at least there's other people in the mortgage that can jump in to help support. We've actually not seen that a huge amount where income boosters are having to jump in, but is there as a backup if they need to, which is probably why we've got such a low arrears book right now.
Yeah, I mean, that's also a good point. A lot of our lending is focused on younger demographics. So, there's a really good stat that on average we're getting people into home ownership 5-6 years earlier than they would have been without our products. But I think there's also an opportunity on the other end of the spectrum. So that is
the later life lending side.
Later life lending. It's very in vogue. A lot of people are talking about that at the moment. But we do see some use cases today, which is sort of the reverse of ours, where you've got young working children supporting their parents into home ownership later in life. So the parents buy the property and then the kids are the income booster. But also what can we do to help people that stay in homes that they may otherwise be forced to sell, or potentially, you get to retirement age, why shouldn't you be able to buy a house if you can afford to own it? I think there's been a real reluctance from the sector to engage with that population because they're worried about the regulatory risk, and I think the regulator is responding to that this year. But why not? If you've got the pension income that can support home ownership, why is that worse outcome than renting? I personally don't believe that it is, but I think the way lenders have been set up, the way regulation has been set up, is that that is risky, let's not do it. And I see that changing this year.
I think this is the point you raised as well, that the big lenders do what they do well, but a lot of it is quite submit a case, check the boxes, does it all fit? Great, done. And because we are getting in, we're more of a specialist lender, we can't do it in such a systematic way as they do. So we do need to have underwriters truly look at case, properly understand the scenario, and not make an assumption that just because you're not PYE and you might need to be buying slightly later in life, for example, that's okay as long as your income supports it, or your benefits, or your retirement, whatever it is that works for that case.
There is no one size fits all anymore.
Exactly.
I mean, that traditional concept of buying a house at X age with X amount of income, it doesn't apply anymore. And that's where I see Gen H offering that flexibility that a lot of people have been deprived of or underserved from. Graham, you touched on, you already kind of hinted to the income booster, but I wanted to ask you, Ashley, what that kind of product is, and tell me about that and what you're actually aiming to solve there as well.
Yeah, so the income booster is really just a variation on joint borrower sole proprietor mortgages, which have been around for, I don't know how long, a very long time. They work to a certain extent. However, for example, the name doesn't exactly explain to many people what they actually do. So even just by rebranding it to make it income booster, so it's quite literally boosting the income to help people get on the mortgage ladder, is a really obvious but really small tweak that made a big difference. There's other things as well, though, that I would say the income booster goes one step further than just a standard joint borrower sole proprietor mortgage. So, for example, with the ejector seat, which I don't think anyone else in the market does anything like that. And all it does is, in our affordability calculator, it is looking at the term that we can lend, and we typically are able to extend the term for owners by looking at the max age of the people on the mortgage, of the boosters, and auto-ejecting them at the point at which they hit our max age criteria. So it means that people can get a lot longer mortgage than they normally would otherwise. So standard GBSP mortgage, let's say, for example, you want to add on a booster who's 75 and we can only lend up to 85. No first-time buyer is going to take a mortgage that lasts for 10 years. That's just not feasible. And our solution allows people to borrow for much longer than that, and in a very, again, sensible and pragmatic way. We also allow up to 6 people on the mortgage. That can be a combination of however they want the mortgage to work for that group of people. So, for example, it could, in theory, be one owner with 5 different boosters if that's what they need, or it could be four owners as friends buying together up until a certain LTV. That's fine. Basically, I was not trying to assume that it's a one-size-fits-all, 2 partners with 1 parent supporting, for example. So we're trying to be much more flexible. The other thing as well is payments as well. So again, we're not assuming that it's going to be only the owner that makes the payment contributions each month. So we've had cases where the income booster said, I want to jump in for the first 3 months and help with the mortgage payment, because obviously it's really expensive to buy a house, to move, to have your conveyancer fees and everything. Yeah. So for the first 3 months, I'll help with the payment contributions. And after that, then the owners will take over the full amount. So we make that really easy to do on our dashboard. And then again, we take multiple direct debits. So let's say one owner wants to pay 70% of the CMI and one owner wants to pay 30%. Again, that's completely fine, and they can adjust the splits in the future however they want to. And we're tracking who's contributing what, so they can see who's contributing towards the equity in the house that they're buying. So we're just trying to make everything really visible, really flexible, and just try and work for kind of modern day scenarios and how people want to own their homes.
Yeah, and it ties back to also just that modern day demand for, we'll touch on it further later, but that wanting that technology, wanting to be able to log on, look at your dashboard, see how much you're earning on this month or who's going to pay what on the next month, and having that flexibility, as you said. I know another massive proposition for Gen H is the new build boost. I saw you recently partnered with Lovell as well, which is very exciting. Congrats. But I wanted to hear more about that and how you kind of see it sitting in with the wider post Help to Buy environment.
Yeah, I mean, it's a really good question. So obviously we've got this interesting dynamic in the UK at the moment where you have on one hand the government and the general view is that we need to build more. And on the other hand, you've got a bunch of developers who are saying, well, we've got a real problem in that no one can afford to buy our houses. Our margins are coming down, we're making less money, our input costs have gone up, we're selling our homes cheaply as we can, within the realms of being a PLC, for example, but we don't see the demands. You've got these two big, almost contradictory problems. Not enough houses, no one wants to buy the ones we're building. And so you can talk a lot about the quality and the type of housing, and I know there's lots of debates going on there, but we thought, well, actually, hang on, what are we good at Gen H? We're good at solving affordability problems. And at the heart of this is an affordability problem. I was and still am a vocal critic of Help to Buy. I don't think it did a good job of really helping people the way it was meant to do, and it used up a lot of taxpayers' resource to do so. I mean, you can argue that they've made a return on that money, but that the taxpayer had to step in because nobody else wanted to take that risk. So there was a big transfer of risk from others to the taxpayer, and what we thought is, well, what can we do? What can we do that doesn't require the taxpayer to be on the hook, but can help more people into homes? And we actually started with 2 different house builders that we spent a lot of time working on this. One of those, which is Persimmon, which was the first new build boost partner, and we looked at what are they doing today to help people into homes. So they offer a bunch of things to customers: discounts, part exchange, deposit contributions, stamp duty contributions. And we said, well, what's the value of that? What, obviously, you've got a list price and then you're doing these things afterwards to help people into homes. What if we took some of that value and we invested it into the mortgage? And that was the genesis of the product. So in a nutshell, what is New Build Boost? It's a 95% mortgage to the customer, but is made up of two parts. So a traditional, it's a single mortgage with Gen H, so you don't have the complexity of Help to Buy where you've got a mortgage over here and a Help to Buy loan over there. Here it is a single product that's packaged the customer with a single payment, a single counterparty to manage, but it comprises of a standard 80% LTV mortgage with a 15% interest-free equity loan, which is, from the customer's point of view, comes from Gen H, but from our point of view, we have two different providers of those bits of funding, which we manage in the background. One is, a mortgage funding partner, and we have several of those, and then the other is the home builder who's helping by providing some capital for that equity loan. That equity loan is interest-free for life, and which again is different from help to buy. It matches the term of the mortgage, so there's never any obligation to repay that unless the mortgage is being repaid. And for the first just over 5 years, what you borrow is what you repay. So it's super simple, super easy. After 5 years, the value of that loan will track the house price. So if the house price were to double, the customer would need to repay double. If it was to half, they would need to repay half. But that appreciation is capped, so it's never more than 2 times what they put in. We expect that most customers will repay within the 5 years because it's a stepping stone product. Get you onto the housing ladder, get you into that house. As I said earlier, most of our customers are younger than average, with an upwards earning trajectory. So the vision is they buy the home, they pay the New Build Boost mortgage for 5 years, and then they move on to a more traditional mortgage, and they have a broader set of options available to them, either with us or with another lender.
There was loads of weird caveats with Help to Buy as well, like how you repaid the loan. You could only do it every quarter and you had to put in a minimum amount, and there was nowhere to easily track what was the outstanding balance. There was loads of weird caveats with Help to Buy, which just didn't make it particularly easy. And again, I think we were able to build this because we build so much of our stuff in-house and most of our systems. So again, because we track the equity of everyone, we could easily add in that additional type of loan and display that to the customer to say, here's how much your mortgage is remaining at, and here's how much your equity loan balance is. And if you want to contribute towards either through overpayments or repayments towards that loan, feel free to do so. But yeah, I think there was a lack of visibility for the customer with Help to Buy.
Of course, and with that Help to Buy, it's the confusion that isn't needed for someone who is trying to enter the property market. It's their first house. It's a daunting experience, don't get me wrong, and the last thing you want is the customer to be completely swallowed and inundated with all these different percentages, facts, stats, everything, all this documentation, and your ability to simplify that and give a bit of reassurance of, okay, right, 5 years you can do X, Y, Z. It does give, it makes me feel better. Even I was stressed thinking about Help to Buy there, but yeah, it makes me feel better sitting here and thinking, okay, it does provide reassurance.
I think that's a really important point, and one of the reasons that we limit the distribution channels for the product. Yeah. So there's a small subset of our broker panel that can advise on the product, which we've curated in coordination with the home builders that are part of New Build Boost. So the whole point is that it is not straightforward. It is not a vanilla mortgage product, and you need to make sure you understand, and we're very keen to make sure the customers understand the product, the pros and the cons, and if there is a better option available to them, we want to make sure the customer's taking that better option.
I think that's because we originally started as direct to consumer rather than through brokerages, so we're always being incredibly concerned from day one of making sure customers understand exactly what they're committing to when they're taking out any of our products. And even though now we distribute through brokers, I think that mentality is just stuck with us, because ultimately if the customer doesn't understand something, we need to deal with it when they have a mortgage with us. So yeah, I think that's why we've limited the panel so closely, to make sure that the people that sell it really deeply understand it and make sure the customers
really care about it.
Yeah, it's such a big commitment taking out a mortgage, and this isn't your most vanilla product on the market. So yeah, I think it's incredibly important they understand what they're signing up for.
Yeah, and you mentioned, Ashley, that you're able to kind of tightly monitor these kind of mortgages because you build a lot of stuff in-house. And that kind of nicely brings me on to my next question, which is obviously a very hot topic at the moment, kind of around data and AI strategy. And I know that Gen H does try and use that to its benefit. And I'm sure both of you have got a lot to say on it, but I wanted to ask you about kind of how Gen H is leveraging that data, AI, and all the likes of exciting stuff down there.
Yeah, I think we really are. So, for example, we are currently playing around with document submission or application submission, sorry. We have these AI agents currently in place, and what they're doing is they're scanning the details that a broker submitted on their application, and then they're scanning the documents as well. So let's say, for example, we've got one AI agent that is looking at income. So let's say the application, the broker said the customer's earning £50,000. We then have the payslip that's come in, and what the agent is doing is it's scanning the payslip, sense checking that the gross income is, let's say, £4,000 a month. It is then working out the maths to say, does 4,000 equate roughly to what the broker said their annual income is? And if it doesn't, what we want to do is we then want to automatically display that to the broker, saying it looks like there's an inconsistency in what you've told us versus what you've submitted. Can you either give us more context through adding a note, or do you need to submit another document, for example? Was it something old that you've submitted? So we are constantly trying to add in extra features that, number one, will help the underwriter, because the real goal is we don't want to do back and forth with the broker. We want to make it as easy for the broker to get a quick yes or no from us as possible. And if the broker's told us something, the underwriter then picks up, has to then manually go work out everything and then go back and say, hey, this doesn't look quite right. We literally want to make it as simple as possible for both our underwriters and for the brokers to either reach a yes or no decision as quickly as possible. So we're really focused on, if we're going to show this to a broker, it has to be pretty much always completely correct. And we don't want a broker to be turned off by 80% of the time what we're spitting back to them as an answer is just incorrect. And they'll get really frustrated and they'll go elsewhere. So we're spending a lot of time training the models, testing the outputs, making sure that what the agents are saying are correct. And then we'll just turn that on straight for the broker. But we've been testing that quite a lot in-house. And then in terms of AI as well, like, Graham's got a hackathon coming up. He suggested we do a hackathon next week called The War on Boring. And what we've been doing is there's so much manual, repeatable stuff in our operations teams that are really time consuming, could be error prone. We have two people double checking everything we're doing, making sure we get the numbers right. They shouldn't have to do that stuff. Literally, you can now use a non-engineering person, spends a few hours learning how to use things like Claude. They can literally go, and we've had loads of people, we've had some of our product managers be able to automate some of that stuff away or create email workflows. It's honestly being able to remove the engineering blocker, because engineers, it takes a while. And now with AI, there is stuff that we can ship really quickly and really accurately out to customers just in a much faster manner. So yeah, the hackathon's got a lot of different ideas of. My pet peeve that you raised was our XQMI has got so huge. The amount of numbers we're tracking is so big, and a lot of it's manual population coming from our different BI tool, from different manual spreadsheets. Number one, can we get rid of the manual spreadsheets? Can we put all that stuff into the system? And then can we have the systems auto-populate those spreadsheets so we don't have humans anymore filling in all the data? It's just a huge time saver, and no one gains benefit from having to manually key in data. It's just, that's not the value. The value is in seeing the numbers at the end of the day. So we're trying to use AI both from an engineering point of view with things like Copilot and PR reviews, but then across the business, we're trying to encourage everyone to see how they can make their jobs
easier,
a bit more streamlined, so they can do the real value add stuff like talking to customers, talking to brokers, like, yeah, the stuff that will really make a difference.
Yeah, I mean, the whole thing is moving so fast. If you asked me that question last week, I'd have said there's probably two prongs to how we're thinking about AI, and I'd say there's almost three now. So the first prong is, I think the way that, you know, everybody in the world feels like they're using AI is just making stuff that you're doing quicker, easier, sense check. So that might be, we have a lot of policies. If you're updating policies, whether that's proofreading, comparing two documents, asking if there's anything you've missed, creating job descriptions, saying this is a template job description, these are the things I want, help me create it. You know, we don't just then ship that out. We will obviously spend time looking at it, but it's that those efficiency tools. How can we just do what we're doing day in, day out that little bit better? So that's sort of prong one. And I think a lot of the world is doing that. I think prong two, and what Ashley spoke about the underwriting is a really good point of that, is then building bespoke tooling, building agents within our system to take on tasks and do them better, to free up human time to do what we're good at. So apologies if I end up talking for longer here, but I think this is a really important point, right? What we are as a lender is we are a really, really human lender. We're making human decisions based on the very specific instances of a case. We are not a computer says yes, computer says no business, but we use a lot of technology. And the underwriting agent is a great example of that. Like any mortgage lender will tell you packaging is a nightmare. Brokers send the wrong documents. We've had restaurant menus sent instead of payslips because they're just trying to get a case moving. Yeah. And then there are certain documents that you're going to that trigger certain questions. But if you've got to wait till a human to pick that up before you ask the question, that's just creating a bottleneck. So this is stuff where we are building our bespoke agents to move things along faster and go, well, that's a menu. Can we have the payslip? Or, oh, look, you sent this payslip, but it's then triggered these questions. So the agent can know what questions we're going to ask. As she says today, that information gets put straight in front of the underwriter, so the underwriter can check it and send it. In future, we will send it straight to the broker at the point of submission. And so those are the two that I would have said last week. Then I think the third piece is then just sort of the general efficiency in the business. So we're doing a ton of stuff with data and data analysis at the moment. You've also got our war on boring to sort of automate more of the day-to-day tasks. But the analysis is really interesting. So in the space of a couple of days, one member of the team basically did an exercise using an AI tool plus our database to go, well, what's our funnel look like? It looks like broker keys a DIP, decision in principle. A percentage of those go to application. Those applications, a higher percentage will go to offer, and then about 90% of our offers will go through to completion. We said, well, let's dig on DIPs. Are all DIPs created equal? If not, what is the difference between the different types of DIP we receive? And sometimes that is what we call a home hunter, in that we have a customer who wants to buy a house, they don't know which one it is. And sometimes it might be, like, I've got a house, can I afford it? And we've always known there's different outcomes for those type of DIPs, but let's delve a bit further. Let's
dip deeper.
Let's dip deeper, yeah.
Should be your slogan.
Does the complexity of a case impact what happens with that DIP? Is a more complex case more likely to end up in an application than a less complex one? Answer is yes, it does. But taking sort of maybe 15, 20 different characteristics of a DIP, we can then create what we call an expected application score. So any DIP across the day, we will look at it and go, how likely is that to become an application? Which on the surface sounds nice, so what? So the so what is that then can, is sort of going back to being human, impact how our sales team then interact with the broker, right? If for example, it's a certain type of DIP that we can see from the tooling and the analysis we've done, that it's just like, it's a low-cost DIP, it's probably not going to convert, or it's got a 1 in 3 or 1 in 4 chance of converting, but it's low complexity. They've probably placed it with 4 different places. That's probably not worth us following up on. If we've got a certain types of DIP which convert at sort of 80-90% into applications, again, that's probably not worth us spending any time on. But then we have this whole host in the middle, which up until two weeks ago, it was a lottery to the sales team whether they had this type, that type, or this type. Now they know who to call. They know who needs the help and the assistance. This isn't about you place a DIP, come on, place it with us. This is about, oh, we've seen that you've placed this. We understand the challenge. We think you know why you placed it with us. Let's talk to you. Are we the right home for this application or not? It's made a huge difference to, A, conversion, but B, it has improved the level of service we're delivering to our broker customers.
And in terms of the data as well, we are in some ways obviously disadvantaged because we don't have decades of data like all these other lenders do, and particularly the big banks where they've got multiple services where they can really understand customer behaviour in a different way that we just can't because we don't have that data. But at the same time, it's complete to our benefit that our data is so clean because we're only 6 years old. We don't have 4 different legacy systems like Lloyds, who bought Bank of Scotland and Halifax and have tried to blend this all together. So even though we have less data, because it's all really clean and it's in one place, we can interrogate it really well, and then again use it to our advantage because we don't have decades of data like others. But yeah, we can at least move fast because it is all really clean.
Yeah, it's about having that pool of information, as you said now, and really utilizing it. And as I've said, it's about optimizing then the day-to-day operations of people at Gen H. They can actually free up their time. They can actually pick up the phone instead of having to rekey into an Excel spreadsheet, which I've seen far too many times, and it's a painful watch. But to be able to suddenly have all these tools, I mean, the industry itself is changing so rapidly, but it's really great to hear that someone like Gen H is actually grabbing kind of hands on the steering wheel and driving it forward instead of being reluctant to really use what the information you already have and leverage it.
Yeah, I mean, there's definitely an efficiency point to it, but I think even more so it's just delivering better service to our customers, whether that be the homeowner or our brokers or our funding partners.
And I wanted to kind of touch now on your different partnerships. I've seen that you've partnered now with Furness, Penrith, Nottingham. How does kind of that partnership with a building society say about collaborating with a lender? And have you found that an exciting time? Have you found it challenging? Do you see more opportunities there with forward flow lending? Or
it's a great question. There's huge amounts of opportunity there. We mostly love working with the building societies, right? We're mission aligned businesses, right? Building societies literally exist to get people into home ownership now. Some of them stray a little bit further afield. I mean, I would argue quite strongly that building societies that specialise in overseas landlords and second holiday homes have perhaps strayed a little bit away from what they're there to do. But fundamentally, we're all there to get people into home ownership. So there is a natural synergy, there's a natural partnership there where we can make it work. I mean, you could say, well, hang on a second, you're not competing with each other? And you think, well, actually, I don't think we are, because A, the market is so big, and B, it's so dominated by the big 5 or big 6 lenders that there is definitely room for the rest of us to see how we can create win-win situations. And that's what we've done. So I think we do 2 jobs so far where we've worked with the building societies. One is, as you guys will be well aware, that there's a lot of I would say evolution, perhaps even revolution at some of the building societies. Transformation, into how do you modernise, how do you compete with the big lenders when you know you can't beat HSBC or Lloyds on price. So what can you do? So they're busy working on their systems, and they're busy working on their tooling and training of staff to deliver better, more bespoke, more human solutions, just like us. But in the same time, what do you do in the meantime? If you just carry on what you're doing, that's possibly going to erode over time. So we provide, by partnering with us, we provide really high quality lending that's delivering, really good risk adjusted returns that fills a gap or a place on the balance sheet, whilst a society is going on its own journey to get to the place where they can do more of this stuff themselves. I think the other use case we see, and the truth is probably somewhere between the 2 of these for most people, is that there are a lot of building societies that are really good at something. Maybe it's agricultural lending, maybe it's self-build, maybe it's holiday lets. They're really good at something, but that's not enough to get them to the size and scale they want to be. And so we make a natural partner in that we can bring them additional volume, additional return, additional deployment of balance sheet and capital to fill that, so they can focus on what they're good at, but still get the scale and size that they want and need to sort of thrive in the modern world. So that's how we've approached it. We've also worked with investment banks, we've worked with credit funds. There are definitely frustrations sometimes with the societies in terms of sort of pace of movement sometimes, and I'm sure we're not always the easiest to deal with, and that we want everything yesterday, and we maybe started off a little bit naive around the size and scope of the governance frameworks at some of these institutions, but we've refined ourselves to work better with them, and I think our partners have sort of moved with us as we've done that as well. So we love working with the building societies, and we hope to do so with more.
I'd call it healthy tension between us and the building society sometimes. Yeah, we probably do know, and we move fast, and we throw a lot maybe in quick succession at them and expect them to move as fast as we do, and that's just obviously not possible. But I do think at the same time, because we both care so deeply about the customer, and because we're not the big six lenders and there's plenty of space to go around, we're kind of all competing against the same group of lenders. So
and you're moving,
healthy tension.
Yeah, you're moving at pace with reason.
Yeah,
it's with purpose. It's not deliberate. It's a purposeful kind of change and movement. And as you said, it's in a way to support them so that they can serve their members better and be that modern mutual that they all aspire to be. And part of being that modern mutual is quintessentially being, absorbing technology and embracing it. And I think obviously your proposition does offer that as well, which is good to see.
Yeah, and if you think about from the balance sheet health as well, right, there's not, I can say many, I'm not sure there are any mutual that is delivering the same level of returns on owner-occupied lending that we are, and we have no arrears, we have no loan losses. So, this is good lending, it's high-quality lending, and there's plenty more that we want to do.
Yeah. Speaking of plenty more, I heard, obviously, you've mentioned that you've just landed in Scotland. I was saying earlier I loved the LinkedIn video with all the haggis, but congrats on that. It's very exciting. With that, where do you kind of see Gen H in the next 2 or so years moving forward if you want to scale and grow? Where do you see yourselves heading?
Yeah, we've got lots to do. We are still really small. We are a tiny part of a big market. We're never going to be a top 5 lender. We don't want to be. We don't think we need to be, but we want to be materially larger than we are. We want to help more people. And what I think is so good about what we're doing is we're not doing this because we want to take cases from that lender over there or that. We're not trying to take other people's. We're not trying to eat other people's lunch. We're trying to help get more people into homes. We're trying to help our intermediary partners serve more of their leads, serve more of their customers. Now, obviously, if there's a case, then it could go to one place or another. We'd love it to come to us, but only if it's the right thing for that customer. And so, we are really focused on what can we do to go from where we are today, lending several hundred million a year to lending a couple of billion a year. Is sort of the 2 to 3 year horizon. And so the question is obviously, how do we do that? Part of that is going to be through playing with the products and propositions we've got today. So, expanding into Scotland, something we wanted to do for a while. Really, really excited that we've done that. Part of that is thinking about features of the products we've got today to allow them to help more people. So, we're big advocates of interest only and part lending. If you used in a responsible way, is a really good way of getting more people into home ownership as an alternative to renting or shared ownership. So what can we do with the products we've got today to expand the number of people that can help? And so there's lots of initiatives there. So they're sort of, call that the easier side of things. And then there is the broader thing of who are we not helping? And part of that is we sort of have these lines in the sand where we go, if you've done this thing in the past, you can't get our mortgage. Typically around CCJs or mispayments. And that doesn't mean that you don't deserve to own a home. There is probably a bunch of people out there with chronic bad behaviour. It would be irresponsible to allow them to have a mortgage, because if they were to repeat that, they'd lose their equity and they'd face the costs of repossession. But there's lots that we think that is not true. Our customers are generally younger, as I've mentioned a couple of times, that, a while ago for me now, but I remember, when you're in your early 20s, things don't matter as much, but actually they might. So why are these people getting penalised? How can we be smarter? And so there's a big project at the moment that's going on to think about how can we just be a bit more grown up and thoughtful around people with sort of cliche terms again, bumps in the road or blips on their credit file that shouldn't keep them out of a home ownership. That will probably come with a price. It will be more expensive than our vanilla lending, but again, if that is a better, for a lot of people, that would be a better option than renting. So how do we create those sort of products? And then back to what we talked about earlier in terms of later life lending, can we do some retirement interest only type products? Can we think a bit smarter about home ownership for the older demographic as well? So there's so much to aim at, and I think we are young. We don't spend any money on marketing. We shoot videos on our iPhone and Waitrose with a bunch of haggises in it.
But it's memorable,
as
apparently.
I said, it's what I like to see. I want to see more of it.
So yeah, I mean, I think to your point, that we want to do more of that. We want to do more to, build awareness of who we are, but not just because we have an ego and want people to know our brand, but if people know who we are, then more intermediaries will think, oh, hang on a second, I was about to tell this case that I can't help them. Maybe I can. How do we get that message to more of our intermediary partners so they're not turning away customers that they could actually be helping?
Yeah, so those incremental customers, you're
Yes.
saying, that wouldn't have got a mortgage otherwise by going anywhere else. And that's the bit where the broker plays a key part in trying to find them for us as well, where they think they just couldn't have got a mortgage ever until they discover our products.
And with that kind of future forward lens, with your kind of propositions on AI and data strategy, where else do you see kind of future use cases or any new use cases coming up? Not trying to, leak anything exciting, but if there is anything which you see, whether it's the industry or the world in general, just adopting.
Yeah, I think the things. The most exciting thing is we probably don't know, right? I think the most exciting things that will come out of AI over the next 2 years, we don't know what they are today, and so that's quite exciting because it's an exciting time to be. Exciting time to be alive, as long as it's not cyborgs that are going to take over the world. For us, I think it is about delivering more clarity and through better understanding of our customers more quickly. So that is, credit scores are a really crude measure of somebody's financial health. Historically, maybe the best we had. I don't think that's true anymore. I think the unsecured space has made better steps in that regard than the secured lending space has. So I think there's a lot to do there with how we assess our customers and moving away from a credit cut-off mentality and
other types of data.
Other types of data.
banking.
For us, it's not necessarily other types of. I mean, obviously, it's all a form of data, but it's not a you did this in your bank account, therefore you're good, or you did that, you're bad per se. But we have brilliant underwriters, and I think we do a phenomenal job of underwriting, but it is quite intensive. But there's a lot of that the AI can do and to help. So how do we bring more of that, special sauce to more people more quickly? So whether that's guiding what we get from a broker at the point of submission, or it's how we interact with the broker in terms of what information we're gathering day one. Maybe there's a case for open banking. Maybe there's not. Something we're exploring. But how are you gathering that information? How are you assessing it? How are you putting it in front of the underwriter so you can give more clarity to your customers, to your intermediary partners more quickly, so they can better understand who you can serve? And then, the plus of that is you're delivering decisions much faster.
I think in terms of the actual inside of the company as well, there's so much stuff that all lenders do, including us, like QC and QA and stuff, which is always done after the fact. It takes a huge amount of resource to do it as well. It's effectively all data that's stored in the system. So for example, checking tone of voice or checking that what we told a broker was right against our criteria, that feels like with AI that could all be given in much more real time as well. So we could give that feedback straight away to everyone and again save huge amounts. It just feels like there's so many different things in the business and for customers and brokers that we could just.
I think that's a really great example. Right now we take QA and QC really seriously. We do a lot of it, but it is, like you said, hugely manual. Yeah. So we can go to a world where we, I wouldn't want to get rid of the staff that are doing that. No. I feel quite passionately like, business exists not just to make money for the shareholders, but we have a bunch of stakeholders which include, our employees. So I feel very strongly about that. So it's about actually, at the moment you've got people running QA and QC and they're looking at, 5% of these types of cases, 10% of these type of cases, and they're going through every last bit. But actually, if you've got AI agents, you can look at every single case and then you direct your QA and QC resource to looking at the outcomes and checking, this has been flagged. And so you go from, spending all your time digging to actually being reactive and learning and developing.
So outcome focused and really thinking, okay, what are we actually trying to get to at the end of the day? What's our mission? getting people on the property ladder. Okay, right, how do we get them on there quicker with ease, but also with that responsibility in mind as well?
Yeah.
It's very exciting time, as you said. I think the unpredictability of it is what makes it more kind of exciting, and there's a lot of innovation happening, which I think we're all keen to kind of get our hands on as well.
Yeah, I think you either have to embrace it as exciting or you view it as scary, and the people that view it as scary and are completely risk adverse to it are just going to be left behind. It's still so new for everyone that it feels like anyone's game right now, but if you're not embracing it now, you'll probably be embracing it in a year or two, but you'll just be a year or two behind everyone else that's already starting to look at it.
Yeah, got to get ahead of the game. Exactly, and I think that's what you're both doing. So to wrap things up, we usually do a quick fire round. So I won't kind of point questions to either of you. I'll just say it out. You guys can fight for whoever wants to answer.
They're all yours.
Who's got the more interesting? Who's got the more interesting responses?
Exactly. But yeah, the first one is a book, podcast, or series that has inspired you that you want to tell our listeners.
Right now I'm reading Let Them by Mel Robbins. I don't know if you've read it, but
I have.
Yeah,
Let
it's
them
all
theory.
about it's all about let people be them, do what they want, and it's all about how you control. And I find it quite interesting with, for example, if you ever feel jealous, it's like, why do you feel jealous of that person? And usually it's because they're doing something you want to do, and actually if they're already doing it, there's a proven path, and you can just embrace it, copy almost what they're doing, adapt it how you want to do it. So I think that's been quite interesting. I'm reading that right now.
It's a good one. I've listened to lots of her podcasts. She's great.
Yeah, and again, from starting with like £1 million of debt to suddenly being one of the most famous speakers in the world. I think the thing I liked with that one is it all comes down to barely anyone stumbles upon success by chance, and you don't ever retain your success by chance either. It's all just really hard work, and if anyone's willing to put in the time and effort, anyone can do a good job based on what they care about. So
I like that. That's
How about you?
one. Do you have one? You can say yes or no.
No, I mean, I don't tend to read a lot of management books or things like that.
It doesn't. It can be any book that you've enjoyed or you've been inspired by. I think
I'm reading a lot of Irvine Welsh at the moment. I'm not sure that it's necessary. We launched in Scotland, so
you're on the train spotting.
So, but you know, I like history. I'm a historian at heart, so history podcasts for me.
Nice. I like that. Rest is history is a good one. Right. What makes a successful leader in 3 words?
How about probably not me?
That's a good one.
Yeah. That's a good question. What, I mean, I think it depends where you are. Sorry, it's not 3 words, is it? It depends where you are.
You're running out.
I think to be a successful leader at Gen H, it's resilience, creativity, and you know, I'm going to use ambiguity as my 3rd word, but really I mean sort of being able to cope with ambiguity and uncertainty.
I'm glad you went first. It gave me a chance to think. I was going to say resilient as well. We're constantly changing, adapting, rolling with the punches. Honesty, I think, is quite a big one as well. Again, because we're moving so fast and constantly changing direction, being honest with the people you work with. I think similar to yours, bold or innovative as well. Again, really rapidly changing environment and having to keep up.
Nice.
Hard.
Yeah. And how do you want Gen H to be described by customers in 3 words?
Oh no, am I going first? Give you the chance to think.
Yeah.
I would say innovative. I think we should be known for being innovative as a new young lender, but like reliable and trustworthy for a broker and a customer. If they're coming to
like
us,
that transparency.
we will take the time to understand your case, understand your situation, and try and help you as much as we can. Oh gosh, that's a hard one.
I mean, we really have 3 different types of customers, right? We have, and we like to think of ourselves as customer success. So we've got the people in the home, we've got our intermediary partners, and we've got our funder partners. And I think, you know, now I need to think of 3 words that cover all 3, but trust is perfect, right? We want all 3 of those types.
Yeah.
So maybe the 3 words are trust, because we want all 3 of those.
Trust
groups.
us now.
Yeah.
Yeah. And then the final one is, if you both had a magic wand and can change one thing about the UK housing or mortgage market, what would that be?
Axe stamp duty.
That was going to be mine as well. It's the worst.
It is absolutely the
That's
single
like a
worst
whole
thing.
other podcast.
I know,
We need
but if
to let's unpack that.
I know, but I
Yeah.
bought during COVID when there was no stamp duty for anyone, regardless of property value. The market was so hot because suddenly there was people wanting to sell and people wanting to buy, which actually helped with house prices as well, because the supply and demand was much more in sync than it is now. And I think stamp duty is one of the biggest
Stamp duty
blockers.
kills liquidity in the housing
Yeah.
market, and that is the single biggest blocker to the housing crisis right now. I personally, this is intuition rather than hard calculations, but I can't help but think if you got rid of stamp duty, or at least significantly cut it, you would end up in a net neutral position on tax anyway, because of all the ancillary stuff that falls through, right? People will just move more, and it's not necessarily, you can cut stamp duty for first time buyers, but if the people who are in their second home and their third home aren't moving because they can't afford the stamp duty on the house above or the next move, then there are no houses for the first time buyers in the first place. So you need, it's really easy to create a headline as a government and go, no stamp duty for first time buyers, or reduce stamp duty for first time buyers. Great, but that doesn't solve the problem. It only solves the problem if you massively reduce, or in my preference, remove stamp duty entirely, and then all of a sudden you will see so much more liquidity in the housing market. It won't happen overnight, but within 6, 9, 12 months, volumes will double, triple in my view, and then that liquidity makes it easier for the house builders to build more homes. It makes it easier for people to find the first home that they want, and then the second home if and when they have children, for example, or even when you're older and you're retiring, you've got this big house, maybe you don't want to move because you don't want to pay stamp duty if you want to downsize. There's a whole lot of negative consequences.
And there's so much ancillary business around buying a house as well that isn't just the mortgage, like conveyancing, the house movers, there's everything.
Furniture,
so
gardeners, builders, you name it.
Yeah, I mean, as I said, it's definitely a whole other podcast of can of worms to open, but yeah, it certainly would give a big boost. Another boost.
Yes. Next
to Gen H's, but yeah. Well, listen, it was so amazing to have you on the podcast today. Thank you so much for joining us.
Thank you.
I'm sorry it wasn't Hollywood, but next time we're dreaming big. But it's been a great conversation, and I'm really excited to see all the different products and offerings that Gen H is thinking about, and getting people on the property ladder, which is obviously a massive, massive thing for a lot of people in the UK. So thank you very much for joining us.
Thank you for having us.
Thank you.